Well, let's get one thing absolutely straight. This market is and has been incredibly bullish. We're about 2 days separated from all-time highs. Yes, all-time throughout history. However, when you start peeking behind the curtain, you can start to see subtle signs of, well, things are getting a little out of hand. However, as John Maynard Keynes once say, markets can't remain irrational longer than you can remain solvent. So on today's stock market brief show, we're going to dive into the snapshot of what's currently going on the shorter time frames. We're going to look at the market conditions. That's incredibly important to pay close attention to because the market conditions can help you identify what strategy that you're using and when it works best. Index products we're going to hop into. We're going to get into some of the intermarket analysis going on behind the scenes, not just stocks and not just index products. We're going to hop into the expected moves there too as well. Got a couple of sectors that I'm starting to see things set up as well. All that and more on today's stock market beef show. If you haven't been here before, make sure to sponsor the video by hitting that thumbs up, subscribing to the channel. It's greatly appreciated. These channels are brought to you by my partners and my Patreons. The Patreons, they pay me $9 a month. Currently, by the way, it is going up in price. It's been $9 a month for years now. It has to go up because I've been adding more stuff to it, stuff that has been costing me more money to run, like the Asher bot. So if you'd like expected moves from a daily, weekly, and maybe monthly, might be coming soon. We'll see. And then also premium and discounts. And then you have tradie ticks and all their commands to get all their types of data. You get my watch list. You get my tight list, which is the stocks from the watch list that are contracting. You get the daily zones fractal document, which is really cool. Look at the bridge bands from a fractal view. I compile a document there, and I give some swing trade setups and ideas. It's not an alert service, people, so don't come in there thinking that I'm going to alert you when I get in, when I get out of stocks. That's not what this community is for. Also, my partners, Interactive Brokers. If you haven't checked out that link, make sure to do so. If you're looking for a new broker, they're what I use for swing trading. I use a couple brokerages, but Interactive Brokers is one of my larger swing trading accounts that I trade from. And if you want to check the link out, make sure to check out what they have there in the campus section, because the campus will give you various courses from beginning to advanced courses for free. They have webinars, they have a great podcast, they have all types of good documentation there. All right, that's enough. Let's get into today's show. All right, ladies and gentlemen, welcome back to the show. There are timestamps in the description below. Let's hop into the market snapshot. We're going to look at the 1 week performance over here for the S&P 500. Healthcare led the way, up 4.65%. Holy moly, where did that come from? Well, they've been probably the biggest laggard, right? And then all of a sudden we get some news overnight that Michael Burry, from The Big Short. Everyone wants to be Michael Burry, know when the top is, know when the market's going to crash. And then Warren Buffett took stake in UNH, United Healthcare, so we saw a big pop there, which definitely helped out LV. Then we had communication services also on a nice big run up 3.58%, getting a little frothy, if I do say so myself. I don't have the chart with me. And then towards the bottom of the list, you can see XLP and XLU, two of which are the sectors that I'm going to be showing you a little bit later because they are contracting right now. And as we know, one of the basic principles of technical analysis is that assets, markets, they move between periods of contraction and expansion. They get all big and crazy. Now, if we take a look over here, and by the way, these are more risk-off sectors, right? So when you see this, that means this is more of a risk-on type of week. And the week ended up, right? SPY was up 1% basically. The Nasdaq Composite up 81 basis points. Qs were up 0.5%. IWM showed out, right? That went up 3% on the week. It was even higher intra-week, but it did tag into its monthly implied move and kind of backed off a little bit from that point. The assets that were down on the week were the dollar and oil, right? The 10-year yield happened to be up a little bit because of the last two trading sessions, getting that PPI data. However, when you see the dollar and oil down like this, that has been a good sign from an intramarket standpoint for the market. So we're going to talk about that in the intramarket section, because if we start to see a bounce going into next week with these products, well, that could mean that we might be seeing some more consolidation and or a pullback in these markets. Now, going into next week, we do have still, you know, we're getting earnings out. We do have a big one over there, Walmart. We have some Home Depot, got Toll Brothers, right? That's going to be an interesting one. These home builders have been looking pretty good as of late, like really recently. And then we have Target as well. So we got a couple of things to just be mindful of if you have any positions in those. Going into next week, there's going to be a lot of talk about the Fed Chair Powell's speech on Friday, right? The Jackson Hole Symposium that's going on. We get the FOMC minutes on Wednesday. We get some building permits and housing starts. So most of the focus is going to be towards the Jackson Hole Symposium. We'll see what happens there. Now, as you've seen this chart there out of the start of the video, yes, things are getting rather overvalued. This came from Simon White, Bloomberg, and it's basically showing you the previous times we were at these type of levels, this percentile, and it's basically saying that number one in overvaluation across the entire board, dating back to the 1929 or the early 1900s, and it's looking at various factors. You can read right here: combined trailing PE, forward PE, CAPE, so forth down the list. And it's not just that, right? There's also the Warren Buffett indicator that takes the total US stock market value and divides it into the annualized GDP. And as you can see here, and we pointed this out prior, that, hey, it's pretty darn frothy. We're actually at a 2 standard deviation. We've kind of coming in here, but a 200% ratio of market value to GDP, right? The last time we were over here, when was that? That was in the 2000s. And then over here going into 2021, when we pump these markets full of lead, meaning the money is supply. You can also look at this chart. I found it to be kind of interesting. The Nasdaq market cap reaches record 145% of US M2 money supply in Q2 of 2025, levels that we haven't seen ever, but dating back to the dot-com bubble. So things are getting frothy, but, well, I mean, liquidity, it's here, right? You can take a look at the M2 money supply, and this thing just keeps creeping up to all-time highs. The S&P 500, weighting of the top 2 holdings from 1980 to 2025, this is looking at NVIDIA and Microsoft, and you can date way back, and it's making up for 15% of the S&P 500, just 2 names in the S&P 500. So that is quite interesting data there as well. We're going to hop into the market conditions because I know that's going to freak people out. They're going to want to be the next Michael Burry and short the market. But the truth is, we're still in positive market conditions from a shorter term perspective. And that's how you got to really take this in stride, right? We don't know when or if, what can break the market, what could be the catalyst of it. Yes, things are getting frothy. We get that, but it's still important to pay attention, like I said in the earlier part of the show, because, right, you got to remain solvent. That's the goal of trading. It's not catching the big win one time, being done, right? You want to stay in this game for the long run, not risk the biscuits and lose them potentially. If we look at market conditions, CTAs do actually still remain buyers, and it is at a rather extended level. So we were talking about over here how they can basically stop out, not become buyers. Well, they have been. They saw a little bit of an uptick here, a little bit of a downtick today. The thing is, this can change dramatically the closer we get to that gamma flip line, which I'll talk about, and it could potentially start to turn over. They could become sellers in a tape, and that could be quite wicked. So we're going to really kind of dive in what that might look like specifically on the S&P 500 chart. You take a look at vol control funds. They remain to be buyers, right? Volatility goes down, helps the buy side in equities here. Looking at vol control funds, it has flattened out a little bit, but just be mindful that also, once again, that gamma flip line is going to be so incredibly important to pay attention to, because the closer we get to that or slip under it, these vol control funds, CTAs, they can become sellers, right? You can start selling into the selling pressure in the S&P 500 and buying into the buying pressure, creating more volatility. If you take a look at back month, first front month volatility, we still remain above 20% there, that 1.20. And as we've seen in the past, when we reach into these levels, as stated in the prior video, you can go through periods of consolidations and potentially even see some pullbacks. Now, I did find it kind of interesting that when you look at this chart, if you pay close attention to it, right, this brown shaded thing in the background is the VIX. And notice that, like, when you start getting this, the yellow line creeps up above 20% or 1.20, you can see that shortly thereafter, the VIX, you kind of get sometimes these spikes. So right here, if you just draw this line down, right, boom, we saw a spike in the VIX. Well, we're over here and the VIX is at these lows. And what I found interesting, as we're in these levels, we're also moving into a seasonal time where you typically get some types of moves higher in the VIX fund. So if you look at the now, which is the red line, and then you look at the seasonality since 1990 of the VIX, and we are basically right in this point, we're moving into a period where you do typically get some heightened volatility. So will it play out the same way? I don't know, but I think that this is cool data and I wanted to share it. Now, we did have a big OPEX today, so I'm going to be interested to see what this looks like going into next week. But as we close off the week, the call wall here is at 6,500. So that's going to be the important level to pay attention to. I did see some traders reach out further here, but I want to see what this looks like going into the next week. But just be aware that 6,500 still remains that call wall. And if we zoom out a little bit, the 6,400 level, right? The 6,500 is the call wall here. 6,400 is down here. That's going to be an important level to watch because I'm going to talk about that in the indices section. Now, this is the gamma flip line, which is just below 63.40. And this just tells you that this is, bullish, right? This is our bullish conditions where you typically have smaller up days and dealers look to buy the dip and sell the rip, right? That's what we're seeing in vol control funds and CTAs as of late. Now, as time progresses and the gamma flip line moves higher, or if price comes down and crosses beneath it, you can rest assured that volatility picks up, right? As we've seen in the past, and I've showed charts to show you when the S&P 500 slips under that, what it looks like. Now, going into next week, we're looking at 64.14 to the lower weekly implied move and 64.85 to the upper implied move for the SPX. So mark those on your charts. Let's go into the indices. We're going to start off here looking at the weekly time frame for the S&P 500. We have a price percent oscillator down here, a percent price oscillator. It's still bullish. We do have the histogram kind of turning down slightly here. This week that we said that we should watch for, well, it was never confirmed. No follow through. We had an inside week and then we broke the high. So this bearish outside week has been negated. Dun, 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 right? I got to add some sound effects, which I'm not going to in post. Now, a couple of levels that I want to pay attention to as we just close at a new weekly high, right? A new closing weekly high at the S&P 500. You want to be careful if we start crossing down last week's low, which is at 63.64 as it stands right now. But we did kind of break out of this and we're holding up. So now you really kind of want to make sure that we can hold that weekly low. Now, I do find it very interesting here on the daily time frame. You do have an RSI that is diverging in a bearish manner. So this has a lower reading here while price action's putting in a higher reading from that prior day. So it's telling you that things are getting, price is strong and it's moving well, but we do have a bearish divergence that's forming in the RSI. So the internals of this move are potentially weakening. Now, we've been in this bullish channel, quite like very, very clean bullish channel, right? You started here, and then we had that volatility day here, and boom, we moved up from that point. So if we do kind of slip off, we could pay attention to the lower trend down here. And if we start to break from that, potentially that opens the door to and around 6,200 to 6,100, which, sounds crazy to me, but really in all, honesty, I mean, that was just, we were there last month, okay? All right, now I want to zoom in a little bit further into July to August and look at the 65-minute time frame with the 5-day moving average, the purple one that's a synthesized 5-day move. Oh my gosh, no, actually, you know what? Cross that out because I forgot to update it. It's the 50-day move. It's a 50-period moving average. It's supposed to be the 30 period to synthesize for a 5-day moving average. So ignore that line. It is what it is. But I want to kind of call out a couple of key levels that I mentioned earlier just a moment ago looking at this specific chart. And that happened to be that 6,400 level. That 6,400 has acted as a level of resistance. And we call that out because that was once the call wall. And we've been in this kind of range here just up until recently, and we broke out of it. So if we start crossing underneath 6,400, there's not much trade in and around this area. And that could be a recipe for, pretty volatile moves back within the range. So 6,400 is going to be a critical level for the S&P 500 to hold. Now, I want to take this a step further here because sometimes you can look at various risk assets that sometimes lead the price action. And Bitcoin has been known to lead risk assets. Now, I'm not looking at BTC USD right now. I'm looking at Grayscale Bitcoin because it looked a little bit cleaner on here, but that's fine. But if I mark out same thing, 65-minute time frame, and you can see that this was the channel and we broke through that channel. And just in the last couple of trading sessions, what happened? We broke back within that channel. So is crypto giving us a little bit of a heads up of what might be to come with the S&P 500 and or the Qs? I will note that the value line geometric index is still diverging also from the S&P 500. So either that means we're going to get some big breath or the market's doing what it's done in the past where we get these lower highs and it continues to go through a period of consolidation and or a pullback. Okay, I want to also talk about NDX. We'll get into a couple indice products and so forth. But there is something pretty interesting from the shorter time frame with the S&P 500 too that's taking place when you look at it next to the Qs. But the NDX, very similar look. You're in a nice bullish channel. We're a stone's throw away, once again, from all-time highs, higher lows. It's bullish, right? It's bullish. This is bullish. However, there are little divergences that are building, right? The percent price oscillator, we have an RSI that's diverging here too. We hit the upper bounds of this recent channel that we're in. So if we pull down a little bit or come in or consolidate like this, it's not necessarily bearish. It would be more bearish if we start cracking back under and then start to come down and look for a potential retest of this interesting 22,000 level. I say interesting because the last times we were here, we saw hits from it, right? So December 18th, boom, we flew from it, right? From here, we broke down, we saw some wicked sell side. Then here, it started to consolidate, and the only way that we can get through it was a gap at the open and then never look back, right? So very interesting level there at about 22,000 on the Nasdaq 100. Now, if I zoom in on the daily time frame and look at the Qs more specifically in this current channel, I do find it interesting, and we'll know in hindsight if it means anything, but the down days, I mean, look at the red volume down here. So on the down days, you're getting like distribution type days, but the price action kind of just keeps on curling up. So is this just like, are we like, I'm just like very interested here to see what happens. If this all of a sudden breaks down and we start heading lower, I think that this will be like, oh, well, didn't you see all of this stuff taking place? Other than that, I just thought that that was interesting, but I'm not going to be basing a big short position or anything like that. One, I don't really short based off of this, but I do find it interesting that you are still seeing distribution days kind of pile on each other. And a distribution day is basically a down day in the Qs, right, with higher volume than the prior trading session. That's what I'm highlighting there. Now, if we zoom in on the 15-minute time frame on the SPYs and the Qs, and you look at the 5-day moving average on both of them, the Qs are down here, the SPYs down here. SPYs are in a really tight range over here, right? When we came up to this level, we said it's typical to consolidate, right? We talked about that on the last video, and we consolidated. Now, I do want to call out the Qs, which can be a leading indication, right, of this S&P 500, because why? Well, because the largest names in the SPY are in the Qs. So if the Qs are going to hold below the 5-day moving average, break down from here, there's a high probability that this S&P 500 starts to break down and follow suit in the very near future. So if you want to be more bullish, you want the Qs to recover this and start to obviously head up higher. Now, I do want to call out these couple index products that have megaphone patterns that are building. They are bullish megaphone patterns. There's bearish ones, but a bullish one would have a pole going up, boom, 1, 2, 3, 4, 5, and then breaking out. A bearish one would start from the downside of a trend and then go like so. So keep that in mind. Now, I'm not one to set up new trade ideas based off of a megaphone pattern. I don't like megaphone patterns. I like volatility contracting. So I like my megaphone to be forced to be looking that way, where price action coils up, not increases in volatility myself personally. But if we do show the IWM, you can see we hit that 1, 2, 3, 4, boom, 5. So we are seeing that increased volatility into and around that 230, and we happen to be also right at the upper monthly implied move. So if this can kind of just doodle around and consolidate, then maybe we can break from 230, and then I would say, yeah, that looks a lot better from that standpoint. If we take a look at the Dow Jones Industrial Average, we hit a new all-time high today, and you can see that this is also in that megaphone pattern where you had a bullish move here. Boom, 1, 2, 3, 4, 5. So now at 45,000, are we going to get a rejection like we have here, like we have here, like we have here, and here? And is it going to come down and potentially consolidate to break out, which would be rather bullish, or is it going to take a little bit more time in this current market? I will note also negative divergence building on the RSI. I do also want to note a little bit more of an in-depth analysis here by looking at Dow Theory, right? This is kind of old school method where you look at transports and the industrials. If you want to look that up, just look it up really quick. I'm not going to break it down all on this video, but if you look at the transports up here versus the Dow Jones Industrial Average, what are transports telling you right now? Well, typically when you have transports lag and don't match the new highs that you're seeing in the Dow Jones Industrial Average for longer periods of times, there has to be some sort of a catch-up because this divergence can't hold for all too long. You know, remember the housing market, HGX, right? That was a big one, topped in 2005, and that never saw another high again, but the S&P 500 kept going higher and higher till what? the financial crisis. Not to say that this type of same thing is going to happen, but we've been diverging and haven't had a new high in transport since December of last year. And the Dow Jones Industrial Average has forced new high over here before selling off. And then we've forced another high over here. And just recently today. So one of two things are going to happen. Transports are going to make a massive comeback, or the Dow Jones Industrial Average is going to be taking a bit of a back seat potentially in the near future. Let's look at some of the other intermarket stuff taking place. I like to look at this chart, oil, the black line, and the 10-year yield. Oil can be sometimes a leading indicator, which would tell me right now that the 10-year yield's moving higher, but oil's been sinking off. So it tells me that, hey, the 10-year yield might be backing off here. However, looking at oil by itself also kind of looks like it might be in the near term a little oversold and ready to have some relief. That could be a potential. Now, I know that there's stuff going on in Alaska right now between Putin and Trump, so there's a little bit of a heightened risk, you can say, that maybe that's, maybe brings oil down further. I don't know if it's going to even affect oil. However, let's keep that in our back pockets and our minds. If we just look at the 10-year yield, price momentum oscillator is starting to curl up as we had this kind of reversal day. So basically, after this day right here was before getting CPI, PPI data. This was CPI data. This was PPI data. And now we're basically slightly higher, which looks honestly like we can just kind of be chopping in this current range. Now, if I look at TLT, as the yields go higher, obviously the bonds come down. It is below its declining 50-period moving average, but we do see obviously some higher highs, and we just recently had a higher lows, and we just recently had a higher high. So are we starting to build out a longer term base for bonds? Are we going to start to see some relief with knowing that rate cuts are coming? Well, I don't know. Maybe perhaps it doesn't matter again, right? We've seen that before. If we take a look at oil now, well, the reason why I said where it looks like it's oversold is because it came down pretty fast and aggressively, like from 70s to the low 60s. And it was down today, but you might be able to look at this and say it's kind of wedging, like a wedge pattern. And yes, it's in a bearish trend, lower highs, right? In the short term, you have some higher lows here, but overall, the 200-day, 50-day, right? The 200-day has been sloping down. The 50 days kind of sloping up, but kind of curling around right here. If we start to break up, we can be looking at 65, 66, 67 in oil, and that could be pretty important to pay attention to, because if oil outperforms and does really well, what's correlated with it is energy stocks. And if energy stocks start to move higher from where they currently are, that also puts pressure on the S&P 500. As you can see right here, energy related to the S&P 500. So when this line goes up, that's just telling you that energy is outperforming on a performance basis S&P 500. And look at what the S&P 500 does. So this goes up, this goes down, this goes up, this goes down. This went up, right? And then it started to top there. Boom, this went down. And where did it stop going up? Where did it stop going down? Right when oil, energy related to oil, right, started going back down. So if energy starts to outperform, we start to see a little bit of a pop-up here. It's likely, looking back through history, that S&P 500 could put on the brakes. Okay, not to say that this is going to happen, but this is what's currently taking place in the markets. I think most people understand that I'm not here to try and predict the markets. I'm trying to provide you with data and some insights that you might not get elsewhere. If we take a look here, this is the Sailor to Shift tool, looking at Bitcoin relative to gold on a 4-week basis. And we did have a sell signal, but there has been no trigger. A trigger would mean that price would have to cross below this weekly low. Now, right now, as it stands, we are above a positive rate of change. So if we close there when this week closes out fully on this candle, if we are positive, that means the sell signal is a no trigger event, and we continue on with the current buy signal, buy trigger, until the next sell signal, sell trigger. Now, there has been a little bit of a reversal here in crypto. So if we take a look, we talked about how this one kind of faded back in that tight range, very similar to what the S&P 500 may do. Is crypto leading the way in a potential pullback? I don't have that answer for you, but I do find it interesting that is what happened on more of a risk on type of asset. Now, if you look at gold, right, this is another important asset to watch for, especially when you're looking at the Sailor Shift tool. It is still contracting, not really going anywhere. We're getting very, very tight within already a contracting pattern. So just be on guard that when this thing breaks in whatever direction, we could see another kind of explosive type move, whether that's to the upside and or to the downside. If we continue on, I like to look at silver on occasion, and I like to correlate it to the miners, because there's typically and has been a very strong positive correlation, but up until recently, that correlation kind of died off. So I'm not giving this much weight here. The GDX has been holding up strong. It's kind of flagging here, but silver actually fell off. So if silver actually comes down, I'm kind of thinking that this is where the miners, if the correlation doesn't, go back, obviously recorrelate, but that could be kind of where miners can take a little bit of a backseat and breathe. But overall, from just an absolute basis, the miners look pretty good. I actually went into a short on miners on this pop up. I think I posted that in the Discord, but I don't think I tagged everyone because I don't really do that on shorts. But then I, on the open of this day over here is when I reduced the position dramatically to basically not even having it on. So I still have a little short position in miners, and I'm probably going to be getting out of that if this breaks higher. Pretty simple stuff. Okay, if we take a look now at a couple of sectors, the ones that I wanted to bring up was the ones that performed the worst on the week, and that's consumer staples. Now, consumer staples has Walmart reporting. Why am I doing? Yeah, Walmart reporting next week, and that's one of the top holdings in XLP. So just be aware that can obviously cause some movement. But you can see we have a high, lower high, lower high, and we're butting our head back into that lower high. But overall, price action is kind of contracting here. So if we start breaking out, now are people going to start to move into more of a safety type trade if all this kind of plays out, where we start to see consumer staples maybe catch a little bit of a bid in the near term? Because overall, they haven't done anything all too much on a year-to-date basis. The next one is utilities. Now, utilities have been contracting, pulling back. It hasn't been helping, too much that we've seen a big spike there in yields these last couple of days. So these are, heavily sensitive to rates. But XLU, I was looking at it down here and we broke out, back tested, boom, moved higher. So we're near, highs for the year right here. And we're kind of just pulling in, contracting, consolidating. So a breakout to retest 88, maybe even go to 90, could be very well a big possibility here if we start to see a rotation back into this more risk-off type environment. The last thing I want to close off here is with the expected moves of the SPY. We already talked about the expected moves for the weekly S&P 500. You can see up here, the upper weekly implied move is at 652.53, 634.35 to the downside. The market's pricing in about plus or minus $9 of expectations of risk. If you think of this in terms of a distribution curve, right, 68% of the time, it's even actually higher with the S&P 500. We go and we tag one of these levels and we typically close within that one standard deviation, 68 to 70% of the time in the S&P 500. Going into Monday's trading session, our daily implied move, 647.40 to the upside, 638.48 to the downside. We still remain in a very tight range as we've been talking about. We're holding above this week's week-to-date VWAP and an inclining 5-day moving average. So I would say be careful if we start crossing below this, right? Because the Qs have already done that. If we hold below that, and if it breaks down, start to look for the lower dailies and the lower weeklies as potential targets. But if we can break up, the Qs start to find some strength, we can start targeting obviously a little bit higher. Just be aware when you put the whole picture together, when you look at back month versus front month volatility, when you look at some of the other indications of risk on assets, taking a little bit of a breather or a little bit frothy from this week of trade, just be mindful that you can see some chop and some really good intraday trade take place, but you just got to be aware. That's all I got for you on today's episode. Hope it helped out. I'll see you on the next.